Very warm welcome to each of you who are joining for this live presentation or accessing its recording. My name is Frédéric Ducoulombier, and as the founding director of EDHEC-Risk Climate Impact Institute, I am delighted to act as the moderator for this session on the climate risk premium, featuring our research director, Professor Riccardo Rebonato. The session will be comprised of a presentation by Professor Rebonato for 45 minutes, followed by questions and answers. Throughout the presentation, you may submit questions through the Q&A function at the bottom of your screen. Close to 1,000 professionals have registered for this session, and it's my duty to select those of your questions that will be put to Professor Rebonato for live answers. As for those questions that are not answered during the session, we endeavor to prepare written answers and distribute them to registered participants along with the slides for today's presentation. Before the presentation begins, I will say a few words to introduce the institution and our speaker today. EDHEC Business School was established over 120 years ago in France and now operates as a global school with campuses in France, Singapore, and the United Kingdom. We have close to 9,000 students coming from other 100 countries the world over, and some 50,000 alumni working in 130 countries worldwide. The school is ranked in the top 10 of European business schools by the Financial Times, and its finance programs have achieved global recognition for their excellence. For over 20 years now, EDHEC Business School has pursued an ambitious research policy combining academic excellence and practical relevance. And this policy was initiated by EDHEC-Risk Institute with the goal of producing and transferring research insights to financial decision makers in key areas for the future of the industry. Some of you may have read our work on asset allocation, portfolio construction, risk management, equity and fixed income strategies, or alternative investment. However, reflecting the priority assigned by the school to sustainability issues, EDHEC-Risk Institute became EDHEC-Risk Climate Impact Institute in the fall of 2022. Our mission is to help private and public decision makers manage climate-related financial risks and explore how financial tools can support a transition to low emissions and climate-resilient economies. And central to this agenda is a research program exploring the impact of climate change and climate change-related policies on economics and finance, from macroeconomy to asset prices. And Professor Rebonato, who acts as our scientific director, is heading this research program. Many of you know Professor Rebonato for his work on the pricing of interest rate sensitive claims, or his major contribution to the application of Bayesian networks to stress testing and asset allocation, which earned him the PMR Quant of the Year award earlier this year. Professor Rebonato trained as a physicist. He holds doctorates in nuclear engineering and condensed matter physics, but spent most of his career advancing derivatives pricing and risk management at leading financial institutions, while at the same time holding visiting and adjunct professorships at top academic institutions. He's published extensively in physics and finance, authoring 10 books and 50 articles, and pivoting towards the economics of climate change after joining EDHEC Business School as a professor of finance on a full-time basis. He has a passion for tackling very challenging issues with quantitative tools, and a talent for explaining the purpose and the relevance of his work to non-specialists. It's an honor and a pleasure to be working with him. And without further ado, let's welcome our esteemed speaker to the virtual stage. Thank you.
Thank you, Frederick. Good morning, good afternoon, and perhaps good evening for some of you. Welcome to the talk. I hope I will be able to live up to the presentation that Frederick has given you. And I want to talk to you today about the climate risk premium. And the key messages that I would like to convey is, first of all, should we care? Is it something that we should be spending thinking time, worrying time about? And as an ancillary question to answer the former, how confident are we about the physics of climate change. And you will see why this is important to answer the first question. Then the next important aspect to look at is if the climate risk premium is indeed important, is this information already embedded in the prices? If not, what can we do about it? And of course, we have to understand as clearly as we can what a risk premium is, and this is where integrated assessment models come in. I will be presenting preliminary results, and I underline the preliminary. You understand why there are many caveats, but I always believe that partial information is better than no information at all. This is in this spirit that I begin the presentation. So, fundamental questions. We all think we know what a green asset or a brown asset. Perhaps these are not the best descriptions. I call a green asset an asset that pays well in states of high climate damage, and a brown asset an asset that pays badly in states of high climate damage. We will think later whether this damage is physical risk or transition risk, but this is my definition of green and brown. And then the question is, should green assets, for instance, carry a positive or a negative climate risk premium? And one may be surprised by this because one thinks a risk premium, almost automatically, one thinks, well, a risk premium is a premium, so it should be positive. Well, not necessarily so. And we will see major financial instruments that in recent years have a negative risk premium. And this is what we are trying to get our minds around. We should not have any preconceived ideas as to whether the sign of a climate risk premium should be positive or negative for a type of security. And then the second question is, if we can wrap our mind around whether the risk premium is positive or negative, should we hedge it? Should we necessarily hedge it? And if we want to hedge climate risk, should we use green or brown assets? And can we expect the climate risk premium to be significant or modest? Where by significant or modest, I can compare to the equity risk premium, where it's huge. And as I said before, another key question is this risk premium currently reflected in the prices? And typically, when one looks at estimation of risk premium, one engages in statistical econometric studies. In my professional life before EDHEC, I was at PIMCO, and part of my job description was estimating the state-dependent risk premium, not climate in that case, but the duration risk premium. And so the empirical analysis is the first port of call when it comes to looking at risk premium. However, in the case of climate, we are finding ourselves in virtually uncharted territory. To do a risk premium study, one needs very long time series. 40, 50, 60 years is a minimum. I tell my students, detecting a risk premium is like detecting the direction of a gentle breeze in the middle of a hurricane. The hurricane is all the unexpected things that happen, and COVID and war in Ukraine and this and that buffet prices in all directions. But then there is an underlying trend in a direction. And if you have a very, very long period, if you can observe prices or returns over a very long period, you can tell this direction, and perhaps you can even tell when this drift is strong and is weaker, or perhaps even negative. But investors have only been keenly aware of climate risk, I would argue, in the last 10, 15 years. And therefore, we are nowhere close to having the richness of information necessary for traditional statistical studies. Furthermore, all these statistical studies, just skipped here. All these statistical studies rely on the fact that the underlying phenomenon is pretty stable. It could be state dependent, but the dependence on the state is supposed to be stable. The slope in the case of treasury yield curves is a stable indicator, despite the fact that the slope might change. However, in the case of climate risk, we are facing a situation where the environment is intrinsically dynamic, and it depends on the action that we're going to take, whether we're going to abate quickly or not quickly. So it is for these reasons that models that I love, but which in my opinion are always the second port of call, become indispensable for answering questions about the risk premium. So let me start from probably the most important existential question: should we care? And what do I mean by this? Well, a necessary, not a necessary but a necessary condition for something to command an economically significant risk premium. I say economically, not statistically. I can determine that something is statistically significant, and I can publish a paper. It's going to have the 3 stars next to this coefficient, etc. But it doesn't mean that it makes economic difference. I'm interested here in economic significance. So a necessary condition for something to command an economically significant risk premium is that it should have a major impact on prices, at least in some states of the world. Typical examples: credit risk, political risk, liquidity. Political risk, when we invest in emerging market countries, for instance, most of the times is dormant or latent, but then when it comes out, it's major and people might lose the whole value of the bond or whatever. So for a significant risk premium to be attached to the price of a security, we should be talking about something material. Does climate change qualify from the point of view of asset prices? So I'm not for a second raising the question. Of course it is. From the point of view of society as a whole, of course it's going to have a big impact, but from the point of view of asset prices, does it qualify? Is it something that we should worry about sufficiently that it might carry a risk premium? And for this, I'm going to take a tiny bit of a detour. And in this detour, I'm beginning to show you the annual CO2 emissions. In the scale, you should read the 3.5 as 35 gigatons of CO2. And the jagged blue line is the emissions which have actually happened. And the red line is simply a linear fit. And if one squints very carefully, perhaps in the second part of the data is going down a tiny bit, but this curve is going up. Let's look at the next curve. The next curve is idiosyncratic, is schizophrenic. I have the first half, the climbing half, which is the historical emissions. And there is a slightly higher number because this is CO2 equivalents, but we are still around in the region of around 40 gigatons per year. And you can see there are little dips due to COVID, etc., etc. But this is the left part of the graph shows you historical emissions. And then the left part of the graph that falls down almost like a stone or like a toboga is the emissions that we need to have in order to stay on expectation with, let's say, a best expectation within 2 centigrades, not 1.5 centigrades, by 2100. The change in trend is precipitous. It is not just the first derivative, but also the second derivative that is changing. So the rate of change has to flip. Something completely different. And we have been saying this for quite a few years now, or we have really to mend our ways. And this curve gets steeper and steeper. And that is what this graph here is showing. This graph shows a series of curves. The relatively thick curve in the middle here corresponds to today. And this is the emission path that has to be followed. So the jagged bit is the last period from 2008 to 2021 that we have experienced. And then it's what has to happen, in this case, in order to stay within 1.5 centigrades by 2100. And as you can see, it's like counting the rings on a tree. If you go backwards in time, each of these lines corresponds to an earlier period. And when the emissions were approximately 27 gigatons, the curve, the bottom curve, looks a lot more doable than the current curve. And if we wait 1, 2, 3, 4, 5, 6, 7 years, basically it becomes unfeasible. So what I am saying here is we all have these numbers in mind, the 1.5 and 2 centigrade by the end of a century, as enshrined as it is there, but the task ahead is massive. So the next question is, has anybody done it so far? We know that in different parts of the world, especially in Europe, some countries have been more effective than others at cutting emissions. And I've done a bit of research and I've trawled through dozens of countries. I'm not saying this because I work for EDHEC, but the country which has cut emissions most drastically is France. And these are per capita CO2 emissions by France. And you need, by the way, interesting, you see there is big dip here. There is the Second World War. That is one way of cutting emissions, but it is not the way of cutting emissions that we're looking for. But then we have something which is healthier, starting from the early 1970s, and it is unique to France. And why is it unique? Because this is associated with the nuclear program that France has embarked on. So this is the, you can see clearly the red line shows you the fraction of oil as a source of energy for France, and you see the rising proportion of nuclear. I'm making no comments here. It will be another interesting and long discussion. Is nuclear the way to go? That's not the point I'm making. I'm just saying the only way that historically a reduction somewhat similar, but still slower than what is required, has been achieved in the world has been by an enthusiastic embracing of nuclear technology that few countries seem to be willing to embrace. So there is a first thing to keep in mind. If we want to keep the problem under control, the task ahead is incredibly daunting. And even this pace of abatement here is nowhere as fast as what is required for the 1.5 and 2 centigrade by the end of the century. So that is the first thing. Second, we all think of a 1.5 and 2 as targets just cast in stone with great precision. If one reads the fine print in the IPCC reports, etc., one sees that these are expectations. There is, if we do such and such, my best expectation for the temperature is going to be such and such. However, what is less readily understood is that the physics part of the problem has a big uncertainty about it. Let me make clear, when I say that there is uncertainty in the physics, I don't mean for a second that we are uncertain whether the planet is warming up and whether the cause of this warming up is anthropogenic. I'm simply saying the transmission from carbon emissions to temperature is known with much greater uncertainty that is not normally acknowledged. Here I am plotting a distribution for a key parameter, which is called the equilibrium climate sensitivity. This is the change in temperature as a result of an instantaneous doubling in CO2 concentration. And as you can see, this it peaks, so the mode is around 2.4, and the average is about 2.7, 2.8. But you can see that there is a huge dispersion. So there is a good 10% chance that this quantity here might be greater than 5, and a 5% chance it would be greater than 6 point something. So all I'm saying here is that we do not have the confidence that we can land the spaceship climate to 0.1 accuracy. We have, and this is the part of the whole problem that we understand by far more clearly. And this is clear implications. So given an emission pattern, so if you tell me how much you're going to emit between now and the end of the century, people tend to think, Oh, then I know exactly what temperature will prevail. And this is what these graphs display. But these graphs display the expectation. They don't give you an idea of the uncertainty. Here I have recalibrated the 17 IPCC models, all approved, taken out the outliers, otherwise it's even wider. And for the same emission pattern, by the end of the century, I have a possible distribution of temperatures between end of the century, let's put it around here, 1.6 and 2.5 centigrade. So what is the point that I am making here? The point that I'm making is that, number one, we are nowhere close to a 2 centigrade trajectory. The change of direction in emissions required to achieve a 2 centigrade is unprecedented. And we are nowhere as certain about the physics of a problem as it is usually communicated. And this, I repeat again, is the area where we are most confident. We compare with the estimation of the damage function, it goes off the charts, the uncertainty. Now, this is facing, we seem to be facing two polar possibilities. Either we manage to contain the climate problem, by which I mean we limit the warming to around 2, where it's 1.5 or 2, 2.2, I don't know, nobody knows. But if we do that, we must do something which has never been done before. That's this picture here. And in other words, as the governor of the Bank of England, the previous governor of the Bank of England, King, used to say, this would require a total rewiring of the world economy. Conversely, if we do not tackle the problem in a decisive manner, we are very likely that it is very possible we might face temperatures well above 2.5 centigrades. And just to give a reference point, the human species, let alone civilization, has never experienced a temperature of 3 centigrade above pre-industrial level. So we would be in totally uncharted territory. So think of these two polar, and then there are shades of green in between, in which perhaps the transition is less dramatic, but there is still significant temperature. So the big changes are ahead. And one should expect this degree of changes and uncertainty to be reflected in prices. One of the things that we learn in Finance 101, that given the same expectation, if you increase my uncertainty, I decrease the price. My utility function is concave. Given that I am uncertain, I am ready to pay less for the same expected payoff. So the uncertainty is huge. So it should be reflected in the prices. And is it the case? Well, it's not so easy to tell. There are different ways of trying to answer the question. And typically what you do is to create an index, a proxy. For instance, if I want to see whether inflation risk is priced, I create an inflation time series. And then I look, when there are inflation surprises, do prices change? And when prices change, I add a beta. Oh yes, these assets change with inflation and these don't, etc., etc. The fact is that the climate risk doesn't have an obvious proxy. And so there have been many, many attempts to create a climate index. And then people have created, Nobel Prize winners have created these climate indices, and then there's been a lot of work also at ERSI, also at EDHEC, in creating climate indices. And then you do the regressions, but really you explain very little, which could be because we have not estimated the right index, or it could be because the prices don't seem to be reflecting at the moment climate information. There are other ways to do it. You can create your long and short portfolio, long green, short brown, and this is a typical factor mimicking portfolio, and you see whether this earns extra return, and this extra return should be the climate risk premium, but we get conflicting results. I mentioned the econometric analysis of excess returns, very short period, results all over the place. Typical quote: systemic environmental factor does not help to explain bond returns on top of financial standard factors. In the case of equities, only for the most obvious sectors, oil and utilities, is the increase in R square, the R square is the explanatory power, of a return regression statistically significant, and even in this case, by a very modest amount, a few percentage points. When I say percentage point, is in R square, not in return. So this is a typical result. You get some people who say, yes, brown assets gain a premium. No, it says green assets. We are in a not very nice situation. So can we attack this problem from a different angle? So if climate information is hardly in the prices, can we estimate what the impact should be? To a price, there are two obvious dimensions. One is the expectation, the discounted expectation. What do I expect the cash flows to be? And this is the traditional part. The second part is the risk premium component. And this is the bit I'm focusing about in this talk. And there is some formulas, we don't have to go through the formula. The intuition is very, very clear. The price is given by the expectation of my future payoff discounted at the riskless rate, plus a term, which is this covariance term, which is the risk premium. Where does the risk premium come from financially? Forget about all the formulae there. It's very, very obvious and it's very, very clear. If I have a security that pays well when I'm feeling rich, when I am in a good state of the world, when the economy is doing well, but that pays badly when my equity portfolio is doing badly, I don't terribly like this security. Therefore, I pay less for it, the price goes down, and the return goes up. It is a positive risk premium. Securities that pay well when things go well and do badly when things do badly, exactly because investors do not like them very much, attract a positive risk premium. That is the intuition. Conversely, if a security pays well in bad states of the world, it becomes a hedge, it becomes an insurance. And we will be looking at treasuries and the Greenspan put and the behavior of treasuries from the late 1990s up until COVID. And we see that the price is driven by the risk premium. And the point I will be making there, the risk premium is not a cherry on top of the cake, sometimes can be as large as the cake itself. In general, all carry strategies are predicated on the extraction of risk premium. You enjoy an extra return, but you pay the price that when things, think of liquidity, think of credit risk, think of political risk, you get your carry, but the strategies all pay badly when the economy is crashing, when things are not going well. That is the intuition. Now, suppose that we identify securities that carry climate risk, a climate risk premium. Do we have to hedge automatically climate risk? Well, investors are ultimately only exposed to consumption risk, not named risk. They're not exposed to liquidity risk and credit risk. They're only exposed to the fact of being richer or poorer in good and bad states of the world. This is not abstract theory. It has been at the heart of fixed income pricing from Greenspan to the COVID crisis. What did Greenspan say? He said, I am not here to double guess the stock market. What I can do is that if something goes badly in the equity market, I will step in to avoid a systemic problem by cutting rates. And in very like Pavlovian dogs, investors have learned this lesson. And this is what happened to the correlation between stock returns and bond yields from the 1950s to COVID. And we have the prehistory theory from 1950 to 1970s, where the correlation was more than negative. Then it became significantly positive up until the time of Greenspan. And then the correlation has been going down and down and down and down. And in this period, I could not make sense of a bond yield of minus 60 basis points unless I explained this is my insurance premium. I am paying 60 basis for a 10-year bond. I could not explain that price unless I said, well, even if I expect yields to be zero for 10 years, I am still paying 60 basis points negative, which is my insurance premium. So a premium can be a big component of a price, and the sign of this premium is can change over time. In this green area here, bonds were moving in the same direction as stocks on average, and therefore they earned a positive risk premium. In this pinkish region here, the correlation was negative, therefore they were acting as hedges, and therefore they were attracting a negative risk premium. So what about climate risk, and what about the climate risk premium? Well, there are two big views of the world here. One is the Barrow catastrophic story, and Barrow has applied this story to explain the equity premium puzzle. And in the climate domain, it says we're going to have high climate damages in low consumption states when the economy is doing badly. And why is that? Because there is a causal effect between the climate damages and the damage inflicted upon the economy. So in this view of the world, the damages from fires, floods, reduced productivity, etc., are so big that they cause economic output to be reduced. That is one view. There is another view of the world that I would call the Banzel-Nyaron positive autocorrelation story, and this story reverses the causal link. It says, actually, think about it. When the economy is doing very well, it is actually using up a lot of energy, therefore it's emitting a lot, therefore the concentration of CO2 is increasing, therefore the temperature is increasing, and the damages increase. So in this case, the causal link is reversed. We are going to find high climate damages when the economy is doing well, when the economy is strong. This is, remember what we've seen here, what is the risk premium is this compensation for getting money in good or bad states of the world. If Barrow is right, green assets do well in low consumption states. They act as hedges, negative risk premium. If Banzel-Nyaron are right, green assets do well in high consumption states. They do not work as hedges. They add to the risk, and they require a positive risk premium. Okay, indeed, this is what a Nobel Prize economist Engel writes about the climate risk premium. He says, academic researchers disagree about whether states of the world with substantial climate risk realizations will have high or low GDP. The former implying a possibly negative price on climate risk, whereas the latter implies a positive one. Good, it's nice to have the terms of the question clear in our minds. So now we know what we have to look at. We have to try and understand, are climate risk, climate damages more likely to materialize in states of good economy or weak economy? But stating the question is not the same as answering it. And as I said, typically these things are answered by doing econometric studies, but we do not have the wealth of data required for these studies. And that is why we have to rely on models. We rely on integrated assessment models, which are variation of dynamic stochastic general equilibrium models. And I won't go into any detail, but I want to give you a flavor because it's important to take a peek under the bonnet to see what these things are doing. So there are 3 blobs, or 2.5 blobs in this picture here. The blob on the right is a traditional dynamic stochastic general equilibrium model. There is labor and there is capital that together with the total factor of production produce economic output. And the economic output is then split between consumption and investment. What we do not consume, we save, we investment, which goes back into capital. This is all classical and people have been doing for 50 years and more. However, there is a little twist to the story, because the greater the economic production, you see the green arrow here, the greater the energy requirement. Therefore, the greater the emissions, the carbon accumulation, the global warming, and the damages that hit economic production. So here is the first feedback loop. And then, however, the planner or the agent in this economy is not a sitting duck and says, well, if I keep on increasing production, yes, I increase my production, I get richer. However, I also increase the damages and that brings down the production. Can I do something else? Yes, I can abate. And this is the orange line that goes 45 degrees downwards. And therefore, I'm going to spend some of the money towards abatement in order to reduce emissions and therefore reduce the damage and obtain the nice sweet spot of balance between consumption, abatement, and investment. So this is, in a nutshell, how they work. For a model of this type, which is obviously very ambitious because it tries to model at the same time the economy of the world of different regions, the physics, and the damages. For me and for you to believe in the output of a model, we have to do a lot of due diligence. Well, the first thing is the model must capture the major sources of uncertainty. And I find it essential that the model should be able to recover stylized facts in the economy, such as the equity premium puzzle or the level of rate puzzle. It is well known that the traditional approaches, technically called the time separable utility functions, either you got equity prices right, but in this case, real interest rates were far too high, or you got interest rates right, but in that case, the equity premium was far too small. Modern approaches that use technically recursive utility functions manage to get both right. And therefore, we make sure that in the models that we use, we recover the way the world works. We recover equity prices, we recover interest rates, not with the precision necessary for trading, but in the right ballpark. So to recover all these facts, we combine a much extended version of a famous integrated assessment model with a seminal work by economists Banzal and Yaron, which have used their long-run risk model to create this joint modeling here. So what is the key idea? The key idea is that I'm going to capture as well as I can all the uncertainty in my system. That is why capturing uncertainty at point 1 is really important. And I have cash flows, climate-sensitive cash flows, and this occurs, think of several parts of a simulation in different states of the world. And I use for discounting these cash flows is discount factor, which is called the stochastic discount factor, that knows whether a payoff occurs in a state when I am rich, in which case I don't value it very much, or in a state where I'm poor, in which case, yes, I value it a lot. So the stochastic discount factor that all comes from the calibration of these things, of a calibration that recovers equity prices and interest rates. That's always my anchor, that I know I'm doing something sensible there. So this stochastic discount factor knows how to discount in a differentiated way the same payoff according to whether it occurs in a good state or in a bad state of the world. If a cash flow occurs in a state of high consumption, high discounting, little value. State of low consumption, low discounting, high value. Okay, we are approaching some results here. Remember, we started from an existential question. And the existential question was, do the largest damages occur in states of high economic activity or low economic activity? Here, the message is very strong and clear. There is a strong positive correlation between economic output and damages. It is not the Barrow story that seems to be correct, but is the Basel and Yarn story. It is economic activity that creates emission, that creates concentration, temperature, damages, etc., etc. And also an interesting thing to look at, there is a big term structure to this correlation that peaks around 30 years, which also makes sense because we say sooner or later, we will bring the problem under control, the climate problem under control, and therefore there will be less correlation because basically we got a handle on the problem. The sweet spot of maximum correlation occurs in approximately 25 years' time. And then you might ask, how robust is this result? If I change some few little parameters in the model, do I get a different picture? No, this is the most robust result from the modeling that we are doing. There is virtually no way of breaking it. So if I have to say with high confidence one statement, this is the statement for which I have highest confidence. There is a positive correlation between output and damages. That's the first one. And slightly more technical, there is a strong negative correlation between damages and how much I discounted. This is almost the mirror image of this picture here. Okay, so first of all, I want to make sure that my model is doing something reasonable. And perhaps this picture here is better to show. Here I have what my model produces for the equity risk premium. Here I have on the x-axis that goes in this direction, a number of risk aversion parameters, and the literature points to the 8.5 to 10 region as to being the most reasonable one. And that shows me I have my model produces an equity risk premium between 5 and 5.5%. If I keep in mind that there is not a US, but a global risk premium, it is a very plausible number. So I am in the right ballpark. Okay. And again, there is the equity risk premium. Well, we can skip this. Now we come to the climate risk premium. What is this picture showing me? Suppose that I have a cash flow that appears in 20, 30, 40, 50, 60, 70, 80, etc., up to 100 years from now. And in one case, I price this cash flow, keeping in mind whether the cash flow occurs in good or bad states of the world. And I take the ratio of this price to the price that I would obtain if the payoff were uncorrelated with the state of the economy. So if it's uncorrelated, I just discounted the riskless rate. If it is correlated, there is a risk premium. And you can see that the climate risk premium is for long maturities of the order of 20% of the price, of the order of 10% of the price for cash flows towards the end of the century, of the order of 5% of the price for cash flows in 30, 40 years' time. Compare this with equities, obviously it's much bigger, the effects there, but this is not an insignificant effect. And if we translate this into a yield premium, we see that the yield premium for the range of parameters, which the literature says are the most reasonable one, becomes of the order of 30 basis points per annum. 30 basis points per annum is a significant amount. Obviously, nowhere as large as the equity risk premium, but something definitely very noticeable. In practical terms, it is in pricing terms, you can think of a risk premium for a 10-year bond like a price the difference implies between roughly 100 and 102.5. It's a big deal. It's a noticeable deal. And again, this I have as a function of the maturity of the cash flow for a relative risk aversion of 10. This is an estimate of the risk premium. Let me make things very, very clear. Don't take these 30 basis points as a precise number. One big message is that this risk premium here crucially depends on how fast I abate. And the reason why is very understandable. If we abate very slowly, then the temperature increase is going to be very high. The damages are going to be very high. I'm going to get the damages. I am not abating, so states of high economic activity will spew out a lot of CO2 because the only way to get economic activity is by burning fossil fuels. So that is, in this picture, the climate risk premium will be large. Conversely, if I am in a world where I decarbonize very rapidly, then obviously the effect is much smaller. So all these quantities here depend on the abatement strategy. This has been obtained for a middle of a range abatement strategy. It is purely to give an indication of the order of magnitude of the effect. So, results. If priced, the climate risk premium should definitely be detected, but currently it is not. So 30 basis points is easy to detect. The climate risk premium increases the slower we abate, increases the more severe the damages are. There is huge uncertainty about the damage function, increases the more risk averse we are, and sooner or later, once we have finally decarbonized the economy, eventually it goes to zero. The billion-dollar question is how fast? Other result, big damages occur in states of high consumption. Therefore, assets that pay poorly in high damage states do poorly in high consumption states. Negative risk premium, they work as hedge. Assets that pay well in high damage states do well in high consumption states. Positive risk premium, they add to risk. So coming to wrapping up, the climate risk premium depends strongly on the speed of abatement. I've explained why. Mildly on the specifics of the damage function. Medium strongly on the degree of risk aversion. For very, very, very long maturities, my forward risk premium vanishes. Sooner or later, the problem is brought under control. We are forced to use models to estimate risk premium because data currently is too incomplete. The models tell us the climate risk premium should be economically significant, and it tells us that it should be correlated positively with consumption. Big damages when we're feeling rich. And the last observation that I will make is that the fact that we fail to detect a climate risk premium in the data, or even a climate beta in the data, makes me suspect that the market is not impounding climate information as importantly as it should. I have written another paper, and it could be another discussion that I called Asleep at the Wheel. And I believe that we are just looking at the risk premium part, but the expectation part is also very important. And if you put the two together, the fact that we are finding it economically so difficult to find a signal makes me suspect that the market is not impounding the climate risk premium. Sooner or later, markets wake up and become efficient, and therefore this can give an idea in which direction the adjustment will go for green and brown assets. Thank you very much for your attention, and if there are questions, I will do my best to answer them, and if I'm not able, I'll ask Frederick to do so.
Thank you, Riccardo. Thank you for this fascinating presentation. As should be expected with the number of participants, we have quite a few questions, and we won't be able to cover them all, but I have selected a few. You started by noting that we didn't know whether brown or green assets could be used as hedges.
Yes.
Why the complication? Why not use carbon allowances for hedging? And why do you say hedging climate risk may not always be desirable?
Okay, there are two very, very good questions and distinct questions. The fact that I am aware of the existence of a price risk factor doesn't mean that I have to hedge it. Again, I put myself in my old shoes of being at PIMCO. If we said, oh, there is duration risk, let's hedge it out, we go out of the market. The idea is the compensation for this risk high or low? If the compensation is particularly high, I might take the risk on board. If the compensation is low, then I don't want to take the risk on board. So the existence of a risk doesn't automatically imply I have to kill the risk. Now, there is a factor that you might be a credit portfolio manager, and therefore you don't have any special expertise in climate risk, and therefore I said, as you hedge your duration risk because you want to focus your ability on the credit part, this is just an example, then you may say, okay, I want to hedge the climate bit. But in general, in the aggregate point of view, from the point of view of a strategic investor, automatically hedging doesn't follow from the fact that a risk premium is there. Second, you say, oh, why don't we just use whatever instrument you mentioned? But my question is, are you going to go long or short? Because at the end of, that's what I meant when I said investors do not care about the name of the risk. They do not care about duration risk, credit risk, liquidity risk, etc. They simply care, is this risk going to hit me? When my big market equity portfolio is doing badly or poorly? That is the key. This was the point of this graph here. The same instrument, treasuries, had a positive and a negative risk premium in different times. So it's not that people say, oh, I got duration risk, I'm going to hedge it. And the second thing is, whether if you really want to hedge, you must know which way around you have to go. So in the Greenspan period, you had to be long treasuries to hedge your equity risk. In the 65 to 2000, you have to be short treasury to hedge your equity risk. So unless I know the covariance, unless I know whether the high damages occur in states of strong economy or weak economy, I don't even know the sign of my hedge.
Thank you, Riccardo. You have highlighted that rewiring the economy to meet the emissions limits consistent with 2 degrees requires unprecedented changes. Do the shifts that you illustrated on the slides include the other transitions required to protect civilization against other sources of collapse like biodiversity, or is managing this transition on top of what you outlined?
Unfortunately, no, it is a parochial view just to limit temperature, and temperature is a proxy of climate damage. It's not because all damages come from the temperature directly, but in a higher temperature, for instance, I have higher humidity and I have higher frequency of hurricanes, etc. So temperature is a proxy. This, unfortunately, only refers to the direct climate damages. Biodiversity, other important things are not taken into account. And even more important, what is missing from this analysis is a possibility of really left field events, such as a minor drying up and warming of the Sahel area, which is the area just below the Sahara Desert, would make the currently marginal agricultural economy of these countries virtually unfeasible. At this point, we have 150 million people without livelihood, and I see migration. So all these things are not included in this analysis. So if anything, even if it doesn't look like it. It is an optimistic analysis.
Okay. Another question whose answer, I'm afraid, will be frightening. Hasn't economic production been largely decoupled with carbon emissions, at least in several countries?
Yes, very, very, very good question. It is true that in the developed world, and especially in Europe, there are two trends. One trend is due to from the switch from good intensive to service intensive. With service intensive economy, it is less hungry for energy. Absolutely true. However, we have to keep in mind that the world is not Europe and the US. And the super important question is two questions. One, what is going to happen to China and India? But here we can glean the direction. We can have a bit of a picture, and I'll come to that if I may. But then the big question is what happens to Africa, to our areas such as Africa. Now, Africa has not been the total factor of production, the economic growth in Africa has been extremely sluggish in the last decade and the last decades. If Africa takes off anywhere close to what India and China have done, and let's not forget that the takeoff of China was as unexpected and unprecedented when it happened, as it might be the takeoff of Africa, which I really hope will happen soon. Now, at this point, we have a young continent that will have to go through the phase of high, not services, but high production, high intensive production. Whether there is an immediate jump to renewable energy, or whether this shift is going to be done in the most traditional way of using the easy technology of fossil fuels is an extremely important question. Something that creates some questions in my mind is that renewable technologies have very low marginal cost of running, but very high capital costs. A continent like Africa is not rich in investment capital. They are familiar, so Central African countries are familiar with the technology, carbon technology, oil technology, gas technology. So the path of this resistance, if there is this growth, would be to go down this route. It would be the responsibility of the West to provide the financing and the technological know-how in order to direct the development in a renewable friendly direction. But we should not think by looking at what is parochially, what is happening in Europe and in the US, where indeed the energy intensity is going down, that this is necessarily the picture for the planet as a whole.
Thank you. Maybe one last question, or the last but one. If you gave this presentation to a politician, they would see 30 bips and take no action in their currently political term. What do you think of that?
Yes, but if I were talking to a politician, I wouldn't say 30 bips. I would say the price for a very long dated, and the price becomes very big. So I would say is a difference in price between 105 and 100. I am talking here more seriously to investment professionals. And for an investment professional, the difference in price between 103 and 100 is significant. Now, from the point of view of big policy decisions, it might not be. No, it is not such a big thing. They will create systemic shocks, etc. But if I'm an investor and I have to say, if my prices over a short period of time will readjust by 30 basis points per annum, it would be a very significant thing from a portfolio manager point of view. This type of readjustment would not be so big as to create systemic risk. But not everything has to be systemic for the thing to warrant the attention of the portfolio manager. Also, please do not focus on that 30 basis points as Riccardo said that the climate risk premium is 30 basis points. That is an order of magnitude coming from a middle of the road abatement policy. If the abatement policy, unfortunately, happens to be much lower, that premium is higher. If luckily is much faster, then I'm all happy and the risk premium will be smaller simply because the problem is under control.
And maybe the final question now, building on your answer about the decoupling of emissions in some countries, are you referring to production-based emissions? What if you look at the consumption of these countries?
There are two aspects. In Western countries, both in the US, but even more strongly in Europe, there are two different trends, both in the same direction. Less energy is used for the same unit of GDP, and less carbon is used for the same unit of energy. So both are going down. And this is, as I was saying, a combined effect. If I've known, I would have put on that slide on. So there are two very, very clear downward slopes of both effects. Partly, the first is due to the fact that we are moving towards services, which are obviously less energy intensive, but also those parts of the economy that require energy, we rely less and less on carbon to obtain them. But this is only true in Europe and in the US. In other parts of the world, I have looked at dozens of countries, and the picture is much more complicated. And especially, and I don't know if it's getting a bit too technical here, one thing that I look at is emissions coming from cement. Cement, steel, plastic, and fertilizers account for 20% of energy consumption and 25% of emissions, and they are very difficult to tackle, not impossible, very difficult and costly to tackle with renewables. If we look at many developing countries at the moment, emissions from cement, i.e. emissions which are very difficult to substitute with renewables, are growing very fast, and they're growing. They are a significant fraction of the total emissions. They're much more than the 25%. So we must, CO2 is what is called in physics a well-mixed gas. It doesn't matter what it is emitted. So we must be very careful not to be provincial and to take, oh, this is what is happening in Sweden, in Germany, in America, and this is how the world is going. From the point of view of climate change, we have to think at population growth, at emission per person, etc., etc. And that is why I go back to what I was saying before, the development path that will be followed by the poorest areas of the continent hold the key to the final outcome of climate change. And of course, what the West decides to do in order to facilitate this transition.
Thank you very much, Riccardo. We upped the allotted time, so we'll have to stop it here. There's been even more questions triggered by some of the answers, so we'll get back to you in writing on the questions. Thank you very much for attending this presentation. We look forward to sharing more of our work with you, and we'll be in touch other email with the slides and the answers to the questions that have not been dealt with during the session, and we'll be in touch to also keep you attuned to developments and events of the Institute. Thank you very much for your attention, and thank you very much, Riccardo, for the presentation.
Thank you to everybody. Thank you for your attention and your questions.